Olá pessoal, sejam bem-vindos novamente aqui ao Event Connection. Eu sou o Thomas Sock e hoje a gente está aqui com um convidado mais do que especial. A gente está com o Joe Burns, ele é Head of Hedge Funds aqui na iCapital. E agora eu vou trocar para o inglês para a gente conseguir conversar aqui com o Joe. Hello Joe, it's a pleasure to have you here at Event Connection.
Thomas, my pleasure. Great to see you.
Great. Joe, can you explain a little bit more about iCapital? What do you do over there? I think it's great for people to know.
Yes, happy to. Firstly, this is just a great event, great forum. I think everyone we've spoken with, our partnership with Avenue, which is really just getting going. We're super excited about it. And in terms of the iCapital story, which I'll tell very, very quickly, the company was founded way back in 2013, so still a relatively new company. But fast forward to today, we have almost $950 billion of assets that we service on the platform. That's through data, that's through securitized or structured investments, and that's through alternative assets. Almost, or now north of 250 billion of those advised client capital investments flow to hedge funds, private market strategies, real assets, infrastructure. So we're a very diverse business. Today we have 16 offices worldwide. We partner with a firm that you're very familiar with, Tomas, and your colleagues, Unicorn, here in Latin America. You know, we think of the wealth channel globally and specifically in Latin America here in Sao Paulo, you know, as being very underrepresented in alternative investing. So utilizing the technology framework that we've built out, the access to funds, the research and the education, hopefully can position advisors to provide better service, value, and more durable client portfolios for the long term.
No, that's great, Joe. And talking about hedge funds, do you think they are suitable for every investor or no? There are some investors that should keep away from hedge funds. What do you think about this?
So I'm probably biased, Tomas, on the question. I've been involved in hedge funds for over 25 years, so my instinctive answer would be yes, but of course then I'd walk it back a little bit. I think if you look at hedge funds just within the alternative asset sphere, and we'll keep it simple in terms of hedge funds and private market strategies, there are certainly two relative advantages that hedge funds have in terms of, you know, suitability. One is they tend to be more liquid, certainly, not always, but most typically more liquid for hedging strategies relative to private credit, relative to private equity. So there's arguably a bit broader applicability there just from a liquidity management standpoint. And two, hedge funds are not that private market strategies are, because, you know, there's such diversification inside of PE and private credit. But, you know, hedge funds can focus on equities or credit, multiple strategies, derivative instruments. They're so diverse. So there too, within a portfolio and asset allocation standpoint, there's a lot of applicability. So a little more liquidity, a little more diversification. So I think those two component pieces suggest, yes, hedge funds are suitable for many, many clients. One counter to that, though, so not to be totally, biased on it, hedge funds, I think, generally speaking, and there are some exceptions to this, but have been a little slower maybe than some of their private market peers to embrace and adopt new structures that make their funds available to more clients globally. And within iCapital, we've certainly seen that start to change. So I can foresee the benefits of the liquidity relative to some private market strategies, how it complements those strategies in a client portfolio. I think the broad diversification of the sub-strategies, and more recently, the different structures that hedge funds can provide increases the sort of availability or suitability for more clients globally. For us, that's great. We think hedging strategies can sit next to private equity and private credit, can complement traditional assets, and more clients that have exposure. Again, foundational research, technology, education, all very important component pieces. But we think long-term hedging strategies should be in many, many different client portfolios.
No, makes sense. And I was on your presentation down here at Avenue Connection, and you talked about the correlation between traditional assets and hedge funds. We have a lot of types of hedge funds, and when we see a first semester like this in 2025 with a lot of volatility, a lot of things happening, how do these hedge funds they perform in a volatile market?
Yeah, because it's a bit of a catch-22 because they are so diverse and we say, heterogeneous. Yeah, it's hard to simplify. But generally speaking, hedge funds perform very well when volatilities increase. Now, there are certain strategies that have a lot of directionality. We call that beta, that may suffer in a period where volatilities go up, oftentimes the pricing of risk assets go down. But generally speaking, hedge funds in a month like April or in a year like 2022, those diversifying characteristics add incredible value inside client portfolios. So on a year-to-date basis, just looking at index level data, sort of the average hedge fund, I'm always hesitant to even refer to anything as an average hedge fund, but, up sort of mid-single digits, sitting somewhere between stocks and bonds, generally speaking, a lot less volatility. Some of the volatility was masked inside even just the month of April with that V-shaped recovery. But if you sort of, look under the hood a little bit more, certainly certain strategies. There are some multi-strategy global diversified hedge funds that are up more like high single digits, maybe even low double digits now on a year-to-date basis. One area that we've certainly been leaning into quite heavily is quantitative trading, just with LLMs, artificial intelligence. The adoption of quantitative techniques sitting next to fundamental research has added a lot of value. So some of those strategies have outperformed. And then lastly, there's one of the sort of major category groups within hedge funds is macro. Macro can be systematically managed. It could be managed on a more discretionary basis. But what we've seen certainly this year, and I say over the past several years, after really a decade of dormant performance, I started my career at a macro hedge fund in the 90s. The 2010s were not kind to macro diversifying investing. That has changed almost 180 degrees. So I think year to date, last few years, and how multi-strategy, quant trading, and macro is positioned, the performance has been very strong on a realized basis, and the value of that differentiated performance has only increased.
And another graph that you showed us on the presentation was the efficient frontier. And when you add some hedge funds to a bonds equity portfolio, you can increase your return by and like diminishing your risk. So you can go like up to the left on the efficient frontier. It was really nice to see this kind of thing that happened with the hedge funds when you put in a portfolio.
Yeah, no, thank you for noticing that. Yeah, so that's a chart, again, it just uses index level data. There's such massive spread, what we call the interquartile spread of specific funds. So we just, when we do educational pieces like that, we just keep it very sort of baseline in terms of index performance. Sure. But you're right, over decades plus, the opportunity set for hedge funds relative to, let's call it a traditional 60-40, has both increased performance and decreased realized volatility. Now, importantly, that doesn't and hasn't been the case every month or every year. And even in a decade like the 2010s, we talked a little bit about this, Tomas. When rates are at zero, risk assets go up dramatically. They're cheap on a discounted cash flow basis. Fixed income is negatively correlated because it's a flight to quality. So hedge funds, the best hedge funds, add value almost always. But I think if you look at the 90s, the 2000s, episodically in the 2010s, but importantly here over the last several years, we're back to that up and to the left. The possibility, potential for outperformance, the likelihood of having a lower realized volatility or standard deviation of returns, a lack of correlation or real dependency on traditional assets, or even worse, a handful of publicly traded stocks. So we think the recent outperformance on an absolute risk-adjusted basis is driven by some fundamental factors that in our view are persistent, likely to remain in play. So the opportunities for hedge funds in terms of outperformance, lower volatility, less correlation is as attractive as it's been for me, at least. I'd go all the way back to the pre-financial crisis days of the early to mid 2000s. Those are the environmental conditions that are making hedge fund investing really, really attractive. We're super excited about it.
No, it's very interesting. Heading towards the end here of our interview, I wanted to talk about this future trends that we have about hedge funds. You talk about macro, but macro, it's something that you started to your career, but now we have like hedge funds about quants, about multi-strategy. Do you see any kinds of trends for specifically Brazilian investors?
Yeah, for Brazilian investors, uniquely,
or Latin America?
Yeah, we had a slide again. I generally speaking, Brazilian investors, Latin America, by and large, we looked at the total state of alternative assets. I think Latin America comprises 1% of total alternative assets right now. So fundamentally, structurally underweight. So I think just the opportunity set, the runway is incredible. So I think if there's any advice or commentary I might give, as it just pertains to alts adoption largely, and a subset of which an important one is certainly hedge fund allocations. Have a plan, stick to the plan. Hedge funds, just take this year, for example. Hedge funds looked great through the middle of April. They looked pedestrian in the next 3 months as risk assets just, again, went on fire. That will ebb and flow. We have been not predicting, but sort of expecting, I think, an environment of higher highs and lower lows. Have a plan, stick to the plan. The foundational pieces are the technology that makes it easier to access these great managers, not only in hedge funds, but in private market strategies. The research and diligence. I'm biased there as a research person almost my entire career, but understanding who these managers are, what they do, what markets they invest in, what risk management processes they may have. And then again, importantly, education. Just understanding, advisors being comfortable and having conversations with clients. It really starts with education. So if you can combine market industry leading technology, what we think of as sort of industry leading research and diligence with foundational education, have that long-term plan, more alternatives for more investors from a suitability standpoint to your question before, we think it just increases the probability that clients will benefit from having long-term better outcomes. And again, that could be higher performance, that could be less volatility, and that could just be a more consistent journey over the course of underlying clients, life's long term. So again, we're very excited about it. And within hedge funds specifically, again, we think the best days are in front of us.
Anything that is said is sticking to the plan it's so important. And when you talk about avenue, we were born to give access to the Brazilian investor to invest outside the Brazil. We have such huge home bias here. It's I think 2.5% of everything that the Brazilian invests is outside Brazil. So when we talk about sticking to the plan, we see the importance of an advisor or someone next to you to help you stick to the plan. Because when you talk about hedge funds, we know that they have lower liquidity when we're talking about traditional assets. So I was talking to Jorge Ovira, and he said about the liquidity. That is probably one of the biggest risks that the investor needs to be aware. So when you say stick to the plan, it's very nice. And if I have a message to give to everyone, stick to your plan. Joe, thank you so much for your time. It was a pleasure to have you here. E muito obrigado, pessoal, por ter acompanhado aqui nossa entrevista com o Joe Burns. Espero que tenham gostado. Se inscrevam no canal para acompanhar todos os nossos conteúdos aqui do Event Connection. Até mais.